Hey there guys, how's it going? Welcome to episode number 3 of the FTSE Show. So we're slowly changing the environment of this place. I have improved in some better audio. We are slowly fixing the lighting. We're still not quite there yet, but we're getting there. But it's starting to look and hopefully become a bit more improved. So today I'm going to dive straight in. We're going to change the way we do this a little bit as well. Hopefully it will be better. It'll be an improvement. We're going to take a look at a company called Antofagasta today, a mining company. So this is a company that floated on the London Stock Exchange in 1995 at a price of 66 pence. And over the last 5 years, that share price has risen by about 76%. So pretty decent effort over the last 5 years. The company have opened 2022, so this year, at £13.64 per share, and now as of, where are we, 23rd of May, I'm recording this, we're at £14.32. So we're up about 5% in 2022, which is pretty good. If you look at many of the UK stocks in this year, 2022, many of them are down quite significantly. So for a company to be up 5%, it's actually pretty good. It bodes pretty well. This is a company who are a major international copper producer. The majority of their activities are in Chile, where they've got 4 mines in operation over in South America. The company's 65% owned by the Chilean Luksic family. I think I've pronounced that right. I may not have done. Luksic. I have no idea who they are. When I do my analysis on these shows, I have maybe 15 to 20 minutes to get across as much key information as I can. Obviously, we have to skip a lot of the finer detail. The whole point of this process and this show, if you will, is to act as a kind of a triage, I suppose. Bear in mind there are 1,000 FTSE stocks out there to look at. If you were to dedicate 10 hours, like I do, to every single company, you wouldn't be able to do it. You'd need a team of people. And so essentially what the FTSE show is all about is to try and streamline that process to very quickly, within 15-20 minutes, let you know whether or not this is a company you should invest in, whether or not this is a company you should consider even spending any more time on, or just literally leave behind, or to sit there and actually put the 10 hours into really analysing these companies. And so that's what I do, and that's what this show is all about. So Antofagasta in 2015 took over a US company involved in copper and nickel mining called Twin Metals, and it sparked a bit of debate because back then when Barack Obama was in administration, he actually declined to renew the leases that the company needed on the lands for the mining project, and they were unable to progress. And that may go some way into explaining what we'll see in 2015 and 2016 in a moment when we look at the core numbers. But it wasn't until Donald Trump then came into power where suddenly that was reversed, and the company were able to continue their project in mining. It sparked a lot of debate because there was a significant environmental issue with the land. Bear in mind it was located in an area of wilderness with lakes and rivers, and it angered a lot of environmentalists, essentially. I say all this because some investors out there, this will be very important information. There are investors out there that have a very strong moral compass when it comes to what they invest in, what they're interested in investing in. To others, they won't care. They just focus on the potential returns of investing in these businesses. Either way, absolutely fine. But I include that information in there for those where this does play a part in their decision-making process. The project's reversal of fortunes angered environmentalists, focused attention on an unusual connection between the Chilean billionaire and the President Trump's family. So, yeah, it sounds like there might be some links there between them. And President Trump has done these guys a favour. So, let's move on. We're looking at the vertical analysis then, very quickly. So this is looking at the revenue that's coming into the business. As you can see, from 2012 down to sort of 2016, we've seen some decline. It's gone from 6.7 billion down to 3.6 billion. And 2015, 2016, those were the years when President Obama stopped them from progressing with this project, right? So I'm not sure when Donald Trump came into power. I should probably check that before I jumped on the show. That you can tell me this in the comments probably. But it looks like we've seen a strong recovery from 2017 onwards, going from 4.7 billion to 4.9 to 5.1, and then 2021 has been a fantastic year for this company, 7.4 billion, so quite a significant jump in revenue. Looking at cost of sales, 0. This is just the way they do their accounts, so there's nothing to worry about. But some companies won't include anything in cost of sales. They'll incorporate it into their expenses. So that's fine. That's what this company have done. So gross profit is going to be the same as revenue because there's nothing to deduct. And gross profit percentage will mean nothing as well. That just looks like 100% every time, again, because there's nothing to deduct from cost of sales. So let's skip to expenses in that case. As we can see from the expenses, pretty consistent, I would say. 3.8 billion in 2012. 4 billion in 2021. So over the last 10 years, we've seen pretty much a consistent expense rate, which is great. As an investor, to know roughly what's going to be spent on expenses every single year, that's a good sign. We can look at the expense percentage. What percentage of the gross profit is eaten up in expenses, essentially? And you can see in 2015, 2016, those percentages jumped to 90%. That wasn't because the expenses jumped high. It was because revenue dropped down. And actually what happened was the revenue came down, but the expenses stayed pretty much about the same. And so as a result of that, that expense rate percentage goes up. At that point, those expense rate percentages were unsustainable. They were not good. So if the company had continued to operate at that kind of level of 2015, 2016, then we would have had some problems and we would not be interested in investing. Obviously, as you can see from 2017 onwards, revenue has dramatically increased and improved, as has the gross profit. Obviously, the gross profit's done the same thing, but the expense rate has stayed around the same. So we've seen quite substantial revenue growth, but we haven't seen that same jump in expense costs. So the company are bringing more money in, but the actual cost of running the business is sticking around the same. It's gone up a little bit, but it's not gone up anywhere near to the same sort of growth levels as the income and revenue. As a result, what that's going to do is that's going to knock that expense percentage down, and we've seen that happen from 2019 at 72%, now in 2021, just a couple of years later, 54%. So that's really healthy. That's a really healthy amount. And then the bottom line there is the operating profit. So what's the operating profit left over after the expenses have been removed? Let's move on to the earnings analysis, the next slide. So we've got operating profit now across the top. We've got then finance expenses. So this is the expense of things like interest on their debt, on their borrowings, that sort of thing. And then underneath that, we've got sales of assets. So sales of assets could essentially be any assets the company own that it's decided to sell off. Maybe it's not part of their business plan anymore or their long-term projects. So anything like that they sell off and they make an income from, we isolate that and we remove it because we don't want that to mislead us as an investor. When we're looking at the profits of this business, they can't rely on selling off their assets every year. And we certainly don't want that to muddy the waters and to mislead us into how much money they're actually making. And so what I tend to do is I isolate those sales of assets and I remove them from the whole process. I do exactly the same thing with the next line, which is other income. What is other income? Most of the time, the annual reports don't tell you, and there's no way of knowing. Sometimes it's money coming in. Actually, sometimes it's money going out, and it just says other. You don't know what it is, but we know it's not part of the everyday recurring revenue of the business, because otherwise that's where it would be. So this is just other money that's come in some other way into the company, and your guess is as good as mine how that has happened. But we don't want that to muddy the waters either. So we do exactly the same thing with the other income as we do with the sales of assets. We remove them. And we want to look at the raw figure of what's actually coming in from the everyday recurring business. We've got the taxes there. Can't really do much about those. That is, they have to pay what they have to pay. And then we've got the reported profits. So the reported profits incorporate the sales of assets. They incorporate the other income. This is what they're reporting in their annual report, says this is how much money we made this year. it's true, they're not lying, but it incorporates money like if they've sold off a mine, if they sold a mine off, which I believe they might have done in 2015, hence the 613 million that came in. If they sell off a mine, well, they can't do that every year. They've only got 4 mines in Chile, so it's not going to last very long if they keep doing that. But they've obviously done that for strategic purposes. Perhaps it wasn't part of their long-term growth. But we don't want to include that. We don't want to see that in the profits because we want to know what actual profits is the business itself making. I hope that makes sense now. I'll stop going on about it. And then underneath that then is true profits. True profits is essentially reported profits minus those extraneous income sources. And what's the actual true profits that we're making? And then the percentage profit is what percentage of those true profits from the revenue. Typically what I want to see is about 10%. I want to find a company that are making at least 10% profit. Why? And it needs to be consistent. It needs to be happening over years. Why? Because if a company's making less than 10% on a consistent basis, then they're probably not going to have enough leftover profits to reinvest into that business in a strong way. When I invest in a company, I want a company that I can buy for X amount of money and it's going to be worth a lot more, heck of a lot more than that in 10 years' time. The only way that's going to happen is if that company grows, because the share price isn't going to go up if the company remains stagnant and just kind of sits at that level anymore. It's got to be a growth stock. It's got to be a growth company. Well, it can only grow. A company can only grow if it's got the profits to reinvest back in that business in order to grow. And it also we need to be paying attention to what is the company doing with those profits? And we won't go into that in this particular episode, but the profits look pretty good with Antofagasta. They're doing very, very well. Obviously, 2015, 2016, they took a hit when the revenue fell. Expenses stayed the same. That obviously is therefore going to affect profits. But most years, they're doing pretty well. They're operating between 15 and 20% profit margin every year, which is great, very healthy, gives them a lot to play with. When we're talking about profits here, we're talking about everything's been deducted now. Everything, all the expenses, all the directors' bonuses, all that kind of stuff has already gone out, and this is the leftover profit, the surplus cash that's left at the end of the year. And if you look at 2021, 2.175 billion in surplus cash. So that gives this company a strong foothold to be able to do something with it, to be able to grow, which bodes well for the share price long term. Because if they invest that in the right way, and that's something that needs to be considered as well, but if they invest it in the right way, maybe in further acquisitions to grow the amount of mines they have, maybe they're moving different types of metals, maybe they expand their capacity and take on more vehicles and more mines, and they can produce more copper. Maybe there's other things they can do to improve the quality of what they're doing. Anything like that. And that's something that as an investor you would want to be looking into. But on face value, very quickly, they have the potential to be able to do that, which is great. Look at the debt analysis then. So what kind of debt is the company carrying? Are they biting off more than they can chew? So we've got the true profits across the top line there. Then we've got the short-term borrowings and the long-term borrowings. And we add those together essentially. Short-term is anything that's got to be paid within the next year. Long-term borrowings is anything that has got longer to be paid back. But what's really important for me is the earnings to debt ratio that I work out at the bottom here. And this is essentially a guide to what is the company making in its true profits relative to how much is it borrowing. In other words, are they biting off more than they can chew in terms of their profits? And as an investor, you obviously don't want to see that. You want to see that they're borrowing. Borrowing is fine because if you can borrow at 5% but make 8% on it, it's good debt, right? So not all debt is bad. But more importantly, are they biting off more than they can chew? Are they borrowing and maintaining that at a level that they can afford to pay back if they need to, based on their earnings power? And that's what the earnings to debt ratio tells us. And if you take 2020 as an example, 3.9 is the ratio. Essentially, all that means is based on their profits that year, they would be able to pay off that debt within 3.9 years, all of it. And so that for me tells me that they are not biting off more than they can chew. Then you take a look at a 10-year span to see if that's consistent and not just a fluke year. as you can see from this, they're doing pretty well. They've always managed that debt relative and within the kind of threshold of what they can afford to pay back. So no concerns there. Yes, they're borrowing about 3 billion in total in 2021, but for a company making 2.1 billion in profit every year, that's acceptable, and we're happy with that. Looking at the equity analysis, then essentially this is what's the value of all the assets the company have. So tangible assets, intangible assets. So that could be tangible. We're talking about the vehicles, the mines, the value of the land, all that kind of stuff. The inventory that they have currently sitting there that hasn't been sold yet. The intangible assets would be things like licenses and rights and stuff like that, which also have a financial value. And so as you can see, 2012, they had an asset value of about 12.8 billion. And over the years, it's gone up. And you can see in 2021, 17.2 billion. So we've seen some consistent growth in the asset value of this business. That's what we want to see. That's good. Then we can see, obviously, underneath that is the liabilities. So this is all the costs, all the things that are costing them money, things like debts, but not just debts. It could be deferred tax, it could be money that they owe other companies that they haven't paid yet, like unpaid invoices, that sort of thing, all that sort of stuff. And then you take the assets, you minus liabilities, that gives you your net worth of the company. And as an investor, I want to see net worth rising. I want to see a company growing, because that's the only way share price is going to grow itself. Okay, if you've got a company that's shrinking or sitting there stagnant, not getting anywhere and not growing as a business, then the share price probably isn't going to do much. And if you're going to be investing in a company for 10, 20 years, you want a company that's showing signs of growth. And as you can see, 2012 net worth 8.8 billion. Kind of stayed stagnant then until 2017, didn't really go anywhere, didn't really drop too much in value, but didn't really grow much. But then as you can see, the last 4 years, last 5 years, I'd say, we've gone from 9 billion to 11 billion in 5 years. So there's some solid growth there. And that growth has really ramped up in the last 3 years, from 9.4 to 11 billion in just the last 3 years. So in the last 3 years, we've seen some significant growth there, which is great. And then retained earnings at the bottom there is essentially a snapshot. Imagine it's a photograph of their savings pot. This is money. This is retained profits, essentially retained earnings. So after the year has gone past and they've got that surplus cash, and they've done everything they're going to do with that cash, it goes into essentially a pot, which is your retained earnings. And you want to see that grow, because essentially it's from the retained earnings essentially where they're going to be able to afford to acquire other companies. So if retained earnings are really healthy, which they are, sitting at 8 billion, that means that should an opportunity come along to buy a competitor or to buy somebody that might add value to your business, you're in a position to be able to do that. And again, as an investor that's looking for a stock that's going to grow in value over the next 10 years, you want to invest in a company that has that potential, has that opportunity, that should the right chance come along, they can jump in. So I do a hell of a lot of analysis on price, because it's great that a company look wonderful, but if they're trading at a price that doesn't make sense, then they're not a good investment, right? You can have a wonderful business, but if they want triple the money for it, it's no longer a good investment. It's not a good opportunity for you. So price is really important. I do a lot of work on analysing what's the right price for the company. I don't have the time in this show to go through why. I teach that to all my members as part of the Sussex Investment Club, and I explain to them in detail in my reports how I've come to these figures. Can't do that on this show. I don't have the time. But what I will tell you is that the trading price today at time of recording is £14.40. Right now, based on current strength of the business, that's the value of the business, the earnings power of the business, I would say that anything up to £16.30 I would consider to be cheap. So they're trading at £14.40. So right now, for me, that's a great price. That makes sense relative to the size and the earnings power of this business. I would happily pay up to £16.30 and consider that a cheap price. So £14.40, looking great. If it reaches £21, I wouldn't pay much more than £21 for these shares. The dividend is coming through at $1.43, because They do all their accounts in dollars, and so it's $1.43 per share. I have used the exchange rate today to calculate what that would be in GBP. That works out £1.14 per share. So if you were to buy a share at £14.40 today, you would be getting a dividend payment on that of £1.14 per share, which works out about 7.9 dividend yield, which is very good. Very nice. So not only have you got a company here that have potential to grow in share price, I think, over the next 10 years based on what we've been looking at, but they're actually paying off a decent dividend as well, which is quite rare. Normally, if you've got a really good growth stock, the dividends are usually pretty poor. If you've got a company that's got a great dividend, they're usually very stagnant businesses that aren't going to go anywhere in share price. So to have both is quite appealing. So yeah, they look very, very good, this company. We'll take a quick look at the leaderboard for season 2, which is slowly starting to take shape here. So we took a look at McCall's. They scored minus 110 points, and I think it was evident as to why. If you haven't seen that episode, go and check it out. Then we took a look at Shoe Zone in season 2. They scored 5 points. They did far better than McCall's, but not a company that I would consider wasting too much time on. But then we take a look at Antofagasta, who scored 75 points. So they're not the best company I've ever found, but they're doing very, very well. And as an investor, if I was going to waste any time, obviously, invest any time is probably the best way to say it. If I was going to invest any time in a company and spend 10 hours reading all the annual reports and really getting to know a company to see whether or not I want to invest in that business, Antofagasta would be on the list. I would spend time, I would invest time looking deeper into this company to see if it's a company that I really want to invest in or not, because all of the key hallmarks of what I look for are present, they are there, they look very healthy financially, and it looks like there's aspect and opportunity there for growth. So 75 points, top of the leaderboard now. It'll be interesting to see if anyone can come in and beat them. But thank you very much for watching. I hope it's been a useful episode. I'll hopefully see you guys in the next one. Cheers, guys.